Welcome to the Hard Money Show, where we talk about real estate, home loans, and media. All right, guys, thanks for being on today. This podcast is going to be slightly shorter than what we traditionally have when we have our guest on. We try to keep this at right about 30 minutes because we're really only going to be talking about two things today. The first thing is we're going to be talking about the Federal Reserve, what's going on with the market, where do we kind of see it going? And then second, I thought it would be kind of fun for maybe if you're another realtor out there, if you're curious on kind of the conversations that go on between realtors or what other realtors are asking. I'm part of a couple groups on Facebook, and I thought it'd be interesting to dive into that and, even kind of maybe give them some advice. So let's jump in. Let's talk about the Federal Reserve. And if you do not know what the Federal Reserve is, the Federal Reserve is a government entity in the United States that helps. They do quite a bit of things. And I don't want to dive into this too much, ultimately, because it can be very confusing, like all finance things are in America. They're designed for the few, not for the masses. And so if you do have an interest of how the Federal Reserves work, how that affects our economy, how it affects the mortgage market, the secondary market, Freddie and Fannie Mac, and Ginnie Mae. So I can definitely talk about these things. I wonder how many people would be interested in it because it is such high level stuff. But if you are interested, I'm more than happy to dive into it, and I can get even somebody else on and we can talk about it together. So, barring all of the information that you probably don't care about, what tends to happen is the Federal Reserves, they do an increase on their end, and that affects the mortgage market. That's really the easiest way to think about it, right? Whether they do an increase or a decrease, typically the mortgage market will respond to that. And if they do increases, typically what they're trying to do is lower the housing prices. And if they do decreases, typically housing prices will start to go up because more people will be buying them. That's supply and demand. And so there's a meeting that just happened here in September. There's another meeting that's going to be happening in November. And there's another meeting that's going to be happening in December. And then another one that should be happening towards the beginning of next year. Now, understand that there's a couple things that happen here as far as it pertains to interest rates in the mortgage market. Ultimately, what we need to consider is what the Feds put out for people, what they put out for the lenders, things like that. There's a plot chart that gets put out. It kind of predicts what they're going to be talking about, what they expect, that they think that the narrative is either going to shift or stay the same. And lenders use that information to essentially put their rates where they want them to be. Now, remember, I work for a brokerage, so that's Orbit Home Loans. We are a broker. Lenders are the ones that you actually do your loans with, and we are the intermediaries between that. So it is very difficult, long, time-consuming, and convoluted to get a home loan. We are the people in the middle to try to make that process easier, to get all your stuff into underwriting and make sure that you close your house on time. This benefits you. This benefits the seller. This benefits your realtor. That's our job, right? Now, keep in mind that the interest rates in the mortgage market don't just typically skyrocket up. It is a progressive thing that happens as we start to move up, and as we start to look at the industry, we start to understand more and more and more that it's not just what's happening in our mortgage market and with realtors and with buyers and sellers, but it has a lot to do with our economy as a country, as well as our economy as a state, and our world economy and what's happening. And so right now we're in a position where interest rates are going up. The Fed are trying to combat that. Housing prices skyrocketed up, and now rates are going up, and they're trying to help with inflation by lowering housing prices to make it so people can afford them by upping the rates. And this makes it difficult in another way. But ultimately, what happened with the Fed meeting is that prices or interest rates have gone up. Now, the lenders kind of know that this is going to happen ahead of time, and so they buffer this so it's not as painful when it happens, and it doesn't seem as dramatic. But it would be really interesting to get somebody on like high up that works for a large lender or something like that. Now, I'm not sure what every lender does, but we know it's kind of a whole, this is what happens. And so ultimately, rates have gone up about maybe 1%. 1% We're looking pretty close to that. Might be a little below that. It might be a little above that, depending on where you're at. And it's been about a week. We've been saying for a while. Now this is just kind of water cooler talk, but ultimately we've been saying that we wouldn't be surprised if by the middle of next year rates went up to 10%. That's a lot. That's really high. Keep in mind that historically we should be sitting somewhere between 6 and 8%. I know that this is like mind blowing because we're coming from a market that was 2%, 3%, and everybody thinks that's where we're supposed to be, but that's not the case. We're typically sit a little bit higher. When stuff adjusts, it might adjust back down into the 4s and 5s. That's when you can refinance. We don't often see it go back down into the 3s, right? And so that was a very unique thing. And then on the other end, interest or the equity in properties rose so drastically. Some places here in Sacramento, they even went up 100% in a year. And so when you look at stuff like that, it can feel really daunting to look at this market and be like, wow, like it's double to buy this house monthly as it was if I would have just bought before. Now, I caution you to believe every realtor that you talk to, but I will say that, and I've had this conversation with some friends and some colleagues, that there is this kind of idea that people think that realtors are trying to cheat them or they're not being honest, and that they say every time is the best time to buy and you should buy right now because you have the money. And that is partially true. The best time, especially in a state that's an equity state, to buy is when you can get into the market, right? And then you have to think of it as a multiple transaction deal. You might get in when the interest rates are low and you be good. But most people, will refinance to some, time to better their rate. And that's just the way it is. But, we were telling people when rates went historically low, and we were telling them that this is when you should buy, and they weren't listening. Oh, I'm going to wait. I think they're going to go lower. I think they're going to go lower, or whatever it is. And it was going up. And even when it was going up, people thought, oh, it's going to crash. It's going to crash. Like was 2008. And it's not going to crash, right? There's going to be a drop. It's going to happen steadily, but it's not going to be a crash. It'll be funny if not funny, but it'll bite me in the butt if there is something that causes a crash. But every indicator right now is pointing there's not going to be any mortgage crash. It's going to be, it's rising, inflation's rising, the economy is rising, and that's the normal ebb and flow of our market. And so what does this mean for you as a consumer? Well, ultimately what it means is that if you were going to try to buy a house at the end of August, you would have probably, for the same exact house, paid $200 to $300 less a month than when the rates went up 1%. Now, that math is very general. Don't hold me to that. It really depends on where you're buying, what you're buying, how much you can put down, what your credit score is at. There's a lot of factors that'll go into that. But ultimately, that's basically where I'm seeing stuff that come in that were the clients that I'm working with. It's gone up. Now, there's a couple ways to navigate this. One is put more money down, right? Continue to pay it down to have a lower monthly cost. You could ultimately, if you can still qualify, you can just take that extra $200 a month if you can afford that, $300 a month, and just continue paying that, right? And then when it does go back down, we can refinance you into something that's more affordable. That's an option. Now, the other thing that is going to be difficult for a lot of people, and this is why we're starting to see the real estate market slow significantly, is that now people can no longer qualify. That's where we're running into a problem. And this has to do with debt to income. And I don't want to get too in the weeds about this, but essentially what it means is your monthly gross earnings against your monthly hard debts. That's like credit card debt. That's if you have another mortgage, if you have car payments, if you have student loans, that sort of stuff. Typically, those against each other, you can't have more than 49% in order to qualify for a loan. So if you have, let's just use an easy number, $2,000, then $2,000 gross a month, and that means that about $1,000 is your maximum for monthly hard debt. And you have to keep in mind that also includes what your mortgage payment's going to be, and what your insurance is going to be, and what your title is going to be, and anything else that it comes in with that. And so this is where people are having a really difficult time, because if they were barely qualifying, and now the cost goes up a couple $100s a month, now they're not qualifying at all, and they have to figure out if they can essentially get more money from somewhere or put more money down or whatever needs to happen. But a lot of people are just saying, man, this is crazy. I can't afford this, because the housing prices haven't dropped enough significantly. Now, keep in mind that, let's just use an example, $200 from that 1% increase, it's an additional $200 a month. Well, if that's the case, if a property has dropped $50,000, well, that still is not enough, right, to cover that a $200 difference. Typically, like a $50,000 drop might be, maybe around $50 a month, maybe $100 a month, somewhere in between 50 to 100. So that price reduction is not enough to offset what that monthly increase is going to be because of the interest rates. And that's where we're starting to sit in the market. And that's a really difficult place for people to be. And with especially considering that interest rates are expected to go up again. Now, will they go up an entire percent? Maybe not. Maybe they'll go up 0.25% or 0.5%. Maybe we'll end the year at 8% total, somewhere around there. But the general predictions is that we're not going to see a significant drop in prices of homes until maybe March or April of next year. And rates are going to continue to go up. And this is going to be difficult for people that are trying to buy. And this is going to be difficult for people that are trying to sell and have a number stuck in their head that they think they deserve for their property, right? There is light at the end of the tunnel. I don't want this to be all doom and gloom. There is light at the end of the tunnel. Ultimately, like I said, California is an equity state. And what that means is this isn't a great state to buy properties where you're going to earn a lot of money month to month off of rentals and things like that. Typically, this is a great state to continue to build equity, barring any significant issues in California. You'll continue to build equity year after year as you look over it, as you look at it over the long-term investment, right? Which is how most people buy their house. They might buy one or two houses in their entire lives. So it is not the best time to buy, but would you rather buy at 7% or 8% or 9% or 10%? Prospectively, it's not a bad time to buy when you consider that rates are going to continue to go up. But it's definitely something to consider. Make sure you're working with a good LO like myself, as somebody that understands real estate and understand what's going on in your local community. That's extremely important because especially in Sacramento, we're made up of so many micro communities. Each little community might be slightly different. So there's a lot to talk about in that. And if you're in that position now where you're considering, like, I have the money to buy, should I buy or should I wait 2 years until the market levels back out? Well, that's a conversation we need to have. We need to set up a roadmap for you. Even if you're 12, 24, 36 months out and you're wondering, how am I going to navigate this market? What's it going to look like? And granted, we don't have crystal ball. We don't know exactly what it's going to look like, but we can look at the long-term trends. We can look at what's happened in the past history. We can kind of make some educated guesses and start to tell you and lay out a roadmap for you. And that's really where you need to be competitive in this market. If you're looking to sell your house, get it on the market as soon as you can, because housing prices are going to continue to drop. More concessions are going to end up happening, and you want to get as much money as you can for this property. And it could be years and years and years until your equity is back where it is right now, right? A lot of people think like, oh, the equity in properties have just plummeted. Well, if over the last 3 years you built $100,000 in equity, $200,000 in equity, and it's only gone down $25,000, over the last couple months or whatever, you still have $75,000, $175,000, $150,000 worth of equity that you built. That's extremely important, right? You're not at the time where you've already missed all that money that you built. So take advantage of that before rates go in and they start to drop your equity more and more and more. Again, we can help you with that. We can help you navigate that. Definitely consider that. So that's where the market's at. It's going to be very interesting to see what happens in the next 6 months. Stay, tuned in the podcast, because not every podcast will go in depth about what's going into the market, but we will have ones like this that will, and it'll be a great way for you to gain a knowledge based on what's going on. And keep in mind that although I am in the Sacramento region, the Central Valley region, the Bay Area region, and that's mostly what I pay attention to. I do kind of know what's going on in California. There is some correlation there that will transpire through the entire state. And so there is some benefit to really just knowing what's going on, in different parts of California. And if you're not in California, this might not necessarily pertain to you as strictly, but ultimately, rates are going up across the entire nation. It's not just California. It's becoming more and more difficult for everybody in the country to buy a house. And so definitely it's important to stay tuned. So that's my little gist on what's happened with the Federal Reserve, how rates have gone up and things like that. I do want to dive in a little bit. Now, this can be beneficial for our realtors that are out there, or it can be beneficial for the consumers that are just interested. But I am part of a real estate mastermind group on Facebook. And typically what'll happen is realtors will post questions that they have for people within the industry. So I thought it could be, kind of an interesting little tidbit. Let me know. I'm still trying to develop this podcast. I really want it to be beneficial for everybody, interesting, entertaining. And so I'm going to put things in here and there and kind of see what hits, what people like, if they want me to keep it or not do it. But I thought this would be interesting. So I'm going to go through some of these posts. I'm going to take a look at kind of what they have, and you kind of get an insight into what's going on. So the first one is, how much do you pay your TC per transaction? Now, for those of you who don't know, that's a transaction coordinator. So some realtors will do all of their own paperwork. That's the easiest way to think about that. And some of them will hire somebody called a transaction coordinator that will handle their paperwork for them. Typically, that means disclosures. So there's a lot of disclosures that have to get signed. If you bought a house, you know this. If you're looking to buy a house, be aware there's a lot of disclosures that are going to come your way. Here in California, typically the going rate that I see for that is $250 to $300. Typically, that is paid by the realtor, not built into your transaction. If it is built into your transaction, I would definitely take a look at that, because that's not typical of the market. But I can't say that it doesn't happen. But yeah, it's somewhere around there. And personally, I do all of my own transactions, but if you're a really high level producing realtor, you're doing 10 or more deals, even maybe 5 deals a month. It you kind of have to start to weigh what is your time worth, right? Is it worth your time to have to deal with all of the paperwork and disclosures and all of that stuff? Now, ultimately, it does fall on the realtor doing the transaction and the broker of making sure that this stuff is done correctly, signatures are done correctly. But you could be spending that time building business, building relationships, nurturing the deals that you currently have, making sure you're getting the highest offers if you're listing, or the best deals if you're a buyer. So definitely something to consider. I think if you're brand new, then you really should learn all of your own disclosures. I wouldn't jump directly into a transaction coordinator, because there's so many people that when they do have to do it themselves, they're not doing it correctly. That's infuriating. As the person on the other side, it's your job to know all of the disclosures that are happening. So I would say, for your first 10, 20 deals, do them yourselves, learn everything you need to learn. Once you know it, inside and out, then you get a transaction coordinator and, do that. So, all right. Would you drive 2.5 hours both ways, so 5 hours total, to show a property? I haven't driven that far. I've driven maybe an hour and a half. I've definitely driven an hour and a half. Nope, 2 hours. I think that's the farthest I've driven. And yeah, I've done it. It just depends on who you're doing it for, right? How much is it worth? How much are you going to earn? This is really where you have to value your own time. And then you have to consider, what does that mean for you for repeat business? What, do you want to do that? Now, for me, that 2 hour drive, I was helping a personal friend that I went to college with. We were in groups together. He's kind of like family. And so you're going to go that extra mile. You're going to do that extra work. But ultimately, I don't want to do all of my business out there. And so it doesn't super benefit me, because I don't want to do business in that area. But ultimately, I wanted to provide the best service I could, as well as help somebody out. So you kind of have to base this on yourself. And you kind of have to make that decision. I don't think anybody can really answer that for you, but traditionally, no. You kind of want to do, the best ways, if you can do business literally in your local community where you live, within 5 minutes of where you live. How easy would it be for you to pop in and out of a house, do a showing, or show your clients around? If you are within a half an hour, which is kind of like Sacramento, greater Sacramento, half an hour and everywhere, that's kind of typical. But once you start going out of that, you really have to set up boundaries and set up expectations, and kind of let people know that, there is an expectation that needs to be met. So, all right, here we go. I love this one. Rates are too high. I'm going to wait to buy. How do you respond to this? This is a perfect question that realtors should be talking to their loan officers with. If you don't have one, reach out to me, because this is something that's going to happen, because like I said earlier, people are so fixated on that 3% that they're like stuck. Now, some people, they're done. They just can't afford to get in the market right now. It's a shame. They just don't have enough money saved or whatever. But there are delicate ways to navigate this. If you just go and tell somebody, yeah, there's nothing you can do right now, just call me when you save more money or something like that, it comes off very, arrogant, comes off very brash, and probably not going to call you back if they do. It's not great. But, there's a way to have these conversations. There's a way to communicate them in a way that shows confidence, that shows a knowledge base, and ultimately services your client the way that they need to be, because it's a scary time in the market, and people don't really know what to do, and they've been saving all this money and they want to get the best thing that they can get. So this kind of leads us into our next one. This market is so difficult. I feel like I'm not doing my job when my listings are sitting on the market and there's no action on them, even after a huge price reduction. What do you tell your seller usually? This is amazing, right? Because you have to understand that because we're coming from a market where houses were selling so quickly, there's 20 offers on the house, it was crazy. And that's still the expectation that a lot of people have. Setting expectations up front is so important. Having those initial conversations before listings go up and tell them, hey, this is a shifting market now. Again, you're not going to know that unless you're talking with your loan officers, unless you're talking with your broker who follows this sort of stuff, your teammates. But this is a shifting market. You need to understand that, and you need to communicate that with your customers, because houses normally do sit on the market for 30 days, 60 days, 90 days. It's not super uncommon in a lot of type of markets. Now, we don't want them to sit that long. We want them to sit for less than 30 days, right? We want to get offers in a week or 2 weeks or after a couple of showings, because it's a lot of work for everybody involved. But it's not uncommon. That's the key word. This is not an uncommon thing that happens. And you need to understand that. And you need to be able to tell them that. And if you're able to communicate that with them and you're able to do it up front, ultimately, I think you're going to create a partnership that's going to be successful. So make sure when you're doing your listing presentations to them, set the expectation. It's going to be on the market for a while. If we're lucky and we find the right buyer, it might go quickly, but don't be surprised if it sits on the market. Does that work for you? That's such a critical conversation to have. Does that work for you? If it doesn't work for them and you never ask that, man, they're going to be upset when they realize that this house is not going to sell in time that they needed it to sell for. So definitely consider that. Question: what do you gift to people who refer you business? Ooh, this is a really interesting question, because there's actually laws that are in place for this. How do I phrase this? There are laws in place that there's price restrictions and there's item restrictions and there's other restrictions in place on what you're allowed to gift people for referrals, right? Because I think in like the earlier times, 2008 and before that, people were essentially buying referrals, and it really comes back to a matter of ethics, right? Whether you land on it left or right, that's how the laws are written. They're ethical problems. You're not allowed to really do that anymore, right? There's small little things that you can do, like give them your business stuff that has a logo on it, a cup or a pen or whatever. You can go out to like get food with people and you can pay for it, so long as you're doing like an educational thing, but you're not trading, right? And this essentially comes back to kickbacks. This is a RESPA issue, and you're not allowed to receive kickbacks for the work you do. So it'll be interesting if anybody commented on this about kickbacks and about whether or not, you're allowed to do this. But I think anything with your company logo on it, and you're giving them as educational based stuff is really the best way to go. And be very careful. Right now, the likelihood of your association finding out what happens is probably pretty low, but people are getting pretty desperate out there, and you never know. You don't want to get fined. You don't want to get in trouble. And some people might not agree with this, because I have had this conversation with people, but it is a fine line as it pertains to, is it a actionable offense on the two parties involved? And a good example of this is if you wanted to do marketing with me, it has to be equal, not one party. The real estate side can't pay more. The home loan side can't pay more. It has to be equal, because that's, you can't essentially say, I'm going to pay for an advertisement so you can give me business. It's stuff like that. So definitely interesting. Doesn't really help the consumer very much, but ultimately, it's good insight. So, all right, let's see here. Who here buys properties that are already renovated to hold? Oh, this is interesting. This is an investment question. I think this will be our last one too. Again, if you like this sort of thing, let me know. And I can actually kind of get this all lined up, and we can do a segment of it. But properties to hold. If you're in California, you're probably buying properties to hold. Unless you have stacks and stacks and stacks of money that you can put into renovations, you can get them done quickly, you can get them done effectively, and you can flip and get that money, then the typical person is buying properties to hold. And the thing that's interesting in this, where it says renovated, I think essentially what they're saying is, do you buy properties that you're not going to turn, or that you're not going to put money into, and then you're going to try to flip them? I think that's what they're saying. And these are called turnkey homes that are pretty much done. The problem when you do that is you buy them at typically their top value. So you're not going to get top value for them when you sell, or you're not going to get much more out of that when you sell them. You might not even get what you paid if you don't pay attention to what you're doing. So that's an interesting question. I think we're definitely going to do a podcast about kind of the investing side of real estate and what that looks like. But, I hope this was helpful. I hope this was entertaining. I know it kind of maybe seems like a little bit of jabbering, but I like to just talk about real estate. I like to kind of provide information. I definitely wanted to get this information out about what's going on with the feds. Thank you guys so much for being on. This is the Hard Money Show, where we talk about real estate, home loans, and media. You guys have a good one.